Hi everyone, welcome to Strike. Today we'll try and discuss the core concept of what markets are all about. We've all heard this, we've all read it. Markets are about herding. People slowly start believing in a theme as prices continue to move in a particular direction. That belief system gets stronger and stronger, and eventually the entire crowd starts to participate. Now, we all know this, that you need to buy when there's blood on the streets, when nobody wants to buy, and you need to sell when everybody is bullish and long. And how do you really do that? Do you speak to your four friends, or do you look at the market data that is available to you? Now, we have a lot of market data available thanks to that which is being given out by the NSE on a day to day basis, both on the futures and options market, breadth, and the positioning of the participants. So, what we are really then trying to do and gauge here is the sentiment in the market. Is everybody bullish or is everybody bearish? And we can actually find out the sentiment by using different gauges. Like I said, you can use inputs from the FNO data, you can use daily price action, and you can use participant data, which is communicated to you by the exchange at the end of each day. And that is what we are going to try and do by looking at two different tools on Strike. One is sentiment indicators itself, and the second one, which you see up here on the right hand side, called diffusion indicators. Now you can open these two from the left hand side menu. You simply go to the central analyze section and you move down, you find sentiment indicators followed by diffusion indicators. Once you click on them, they will open up as tabs, and we will start off with sentiment and then go to diffusion. Now, what is the difference between sentiment and diffusion? While they are both trying to tell us the same information as to whether the crowd is pulling up stocks together or is the crowd completely long, the difference is that diffusion is a type of activity where we are measuring behavior of all the stocks in a particular basket. So we could take the basket of, say, FNO, we could take the basket of Nifty 50 or Nifty 500, and then run a particular technical reading on it. We could say, okay, let us look at all stocks that are making new highs. Let us look at all stocks that are giving us buy signals on the Rohit momentum indicator, and so on and so forth. So when we are running it across a basket of stocks, it's not a normal indicator which is only on the price of the underlying, which is like an RSI or an MACD, or a moving average, which is only on the underlying price. You're running it on a basket, and that is why it's called diffusion. You're diffusing what is found in data across an entire basket. So some sentiment indicators are also diffusion, but because there are many other diffusions that people may want to do, we've created a completely separate section for that. But the most important ones that we find useful have been included inside the sentiment indicators itself. But we'll look at both of them together because different indicators can be suitable for different time frames, and therefore it's really important to understand which one to use when. And so we'll start with the most short period of time, which is like a couple of days, and start there and then move on to what we find useful on a slightly higher and then higher time frame, and accordingly you'll get a gist of what we are really trying to do over here. So the first one you see on top, which I find extremely useful, we look at it almost every day, is called the momentum swing. Okay, it is a kind of diffusion indicator, but very useful to gauge the sentiment in the short term. Probably the only one which has the shortest duration time, I think, among the indicators that we've included over here. The importance of it is that it moves between 0 and 100. And what do we really measure? We are measuring how many stocks are showing the Rohit momentum indicator as rising, and that is plotted as a percentage. So that means that if the reading today is at 29, it simply means that today 29% of the stocks are showing a rising RMI or rising Rohit momentum indicator. So if the RMI is going up for 29% of the stocks, we plot 29 as the indicator, which obviously means that 71% of them are showing the RMI declining. So what tends to happen with this indicator gyrates between the range of 0 to 100, but readings above 90 are considered as extremely overbought, and readings below 10 are extremely oversold, though you can have mid-range readings also between 20 and 80. So every time you get to the zone of less than 20, we start wondering whether you are getting near to an oversold condition in the market. Sometimes the recent history can also tell us a bit about that. So if we have a reading, say, multiple times near 21, 22, acting as a short-term bottom in a rising market, that can work. But whenever you get a sharp sell off, especially if the broad market is also declining, you'll usually get a reading which is closer to or less than 10, which means in single digits. And those kind of readings can be very good short term points from where the market can reverse. So if you're in a bullish market, we end up actually looking for opportunities to buy whenever the swing dips very, very sharply. So say for example here it dipped to a reading of 8. That was essentially this short term bottom from where it went up for the next couple of days. Even readings, like I said, sub 20 can give you certain points. Like here it reached a reading of 17, and once it started to move up from there, we went to a new all-time high. So again, I'm mentioning this is a short-term reading. It doesn't mean that every time you'll go to a new high. Sometimes an extreme reading can simply mean a bounce for a day or two and then fall again. So if it is a declining trend in the market, say from here December to March, the market was falling. Every time you had an oversold reading like this, a reading of 12 over here, what did it mean? The market stopped falling at this point and it did bounce up a bit. Okay, now this is also quite a bounce. Sometimes it may just end up being for a day or two. So I'll show you different examples. And here you have another low reading. It came in at around 12 again. The market did fall for another day or two and then rebounded from there. So this is what ends up happening. Now, like any classical indicator, you may even be able to spot positive and negative divergences inside of this. But this is the most basic setup. So the opposite of this is that if the market is going up and you get an extreme reading, very, very high reading, it can mean that the market pauses. So here you got a 92% reading, which means 92% of the stocks are showing that the RMI is rising. At that point of time, the market just went flat for the next 3 to 4 days. So you even get that kind of a situation where a high reading can simply mean, okay, let's pause over here and think for a few days and then we go up again. So a high reading can give you that indication that, okay, you're coming close to a pause, and you may then end up, watching out for that. So very useful, specifically if you're trading short term, you're trading options, you want to know those price points where you want to enter, exit, or trail. This sort of gives you an indication that, okay, now is the time to take those kind of actions. I also mentioned that you will see divergences. So there are points of time where the market may make a slightly higher high and the indicator may make a slightly lower high, and that can end up being a negative divergence. Very, very similarly, close to a market bottom, you may even witness that prices do make a slightly lower low, whereas the indicator makes a slightly higher low, and that can end up being a positive divergence. So multiple uses, extreme readings, divergences, but like I said, it's a short-term tool for a couple of days. Now we'll widen our experience. What we have also done here is given you an average swing, which tries to do the same thing but looks at the 9 EMA of the RMI and plots it. Sometimes I like to use a combination of the average swing and the swing. You may visually feel both look quite similar except for the smoothing effect which is there in the average swing. What I do like sometimes is that at important turning points, both the swing and average swing will together become overbought or oversold. So say for example at this top, this has reached a reading of 87. And the daily swing also had a reading close to 80, much ahead, So it was 80, but the other one came to 87 only later, in the first week of September. And that is closer then to the top than the first reading by the daily swing. So when we combine the two, we can get certain extreme data points. For example, here you fall into 7 at this bottom on the average swing. And on the daily swing also you have a reading of 6. Now both of them are giving you single digit readings. And that simply means that this is an extremely oversold condition from where prices can advance. Now we move to slightly wider time frame. So if we go a little more medium term, then you will find utility in looking at the 20-day advanced decline ratio. Okay, and you might also find utility in looking at the put call ratio based on open interest. Let's look at both of them. Okay, these move in one higher time frame. What we are essentially doing in the 20-day AD ratio is, an AD ratio is total advances divided by total declines for the day, plotted as an indicator. But the individual indicator can sometimes be erratic. So what I end up doing is taking a 20-day average of that indicator and then plotting it so that you get a slightly more smooth line and you're able to spot divergences. Now in breadth indicators, extreme data points are not always useful. In fact, more often than not, you will find that the AD ratio tends to diverge from the market much ahead of time. So it gives you time, it gives you patience to actually play this thing out. So even at this particular recent top, you can find that the AD ratio is making lower highs even as the market is making higher highs. This kind of a pattern is very, very visible, and the most often you'll find divergences at bottoms and tops. But sometimes we've put red lines here. You can actually find extreme readings when you have an up down type of market. So when you have a zigzag market which is gyrating very sharply, so here you had a very sharp fall, then a very sharp rally, then a very sharp fall. In this kind of a situation, you will find it useful that certain extreme readings itself can be a sign of a top or a bottom, like this one here. Okay, this reading was itself a sign that you had reached the top, which is marked over here. So we can do that. We can sometimes get readings that are extreme and that also end up working, but not always the case, and that is why each case has to be taken very, very differently. So similarly, during this up down cycle, we also saw this extreme point where we ended up seeing a top. Okay, but while we were going through this bottoming process, we did see a positive divergence in the breadth, where the new low in the market did not result in a lower low in the AD ratio, and that sort of ended up becoming a positive divergence. So be aware of this behavior, but like I said, this helps us capture these highs and lows, and that's where it's particularly useful. The second ratio which also helps us do that is the put call ratio based on open interest. Now the put call ratio based on open interest moves up and down with the market, which means if the market is falling, the OIPCR also tends to fall. If the market is rising, the OIPCR also tends to rise, and the indicator will have a trading range for that particular time period. So here in this time period, for example, we find most of the market tops occurring near this level, closer to around 1. So when the PCR is close to 1, we more or less say that we may be close to a top in the market, and that is what we end up looking for. So I'll just just looking for an arrow indicator that I can actually use to show you those points very, very clearly. Here, let's use this marker now. So if we are looking at this, for example, this is the first extreme point that we're actually finding over here. Here's another one. Here's another one. And then there are multiple extreme points here, 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 and here. And what did they mark? This one marked a very short-term top, lasted only for a few days. This one also did something like that. But it occurred very, very close to the previous high. We look at what that means. This one occurred at this top, and the last one has occurred way, way early. So what we also do get, like in any indicator, is divergences. So sometimes the peak reading may be close to a top, sometimes you will get a negative divergence, which means a higher high reading with a lower low in the index, right? So that's something we need to notice again over here and here. This one of course was peak data and peak reading, and here again we have a negative divergence for a while before you actually got prices rolling over. Now the reverse is also true at bottoms. The bottom readings also will reach an extreme near down here around 0.7, where many of the bottoms will occur, and you may get either extreme readings or you may get positive divergences. Now the tendency for extreme readings during sell-offs tends to be higher because sell-offs are very emotional. They occur often in V shape, and if there's a very sharp fall, then the reading will be also extreme at the bottom. But if you do get a period where it's slower in developing a bottom, then you can end up with a positive divergence, as we can see at this low. Very similar to what we saw in the AD ratio, 20-day AD ratio, you saw a positive divergence between these two bottoms. Now medium-term highs and lows can also be seen in positioning. So you see something known as participant positioning. The NSE provides us daily data of positioning. What that means is, are all investors who are participating in the market, which have been divided into 4 categories, which is client, that includes all the HNIs and corporates; DII, that's the domestic institutions; FIs, which we all know, the foreign institutional investors; and Pro, which is the prop desks at various institutions or brokers. So these 4 categories is where the reporting happens. All the members who are in that category end up, their data is picked up, NSE picks it up and then tells you whether they are long or short in index options, index futures, or in stock options or stock futures. And that data we've plotted here, we've essentially taken the futures data in this particular case to tell you whether, in terms of number of contracts, how long or short is the institution. And we've actually netted, in fact, in this data, we actually net up the long minus short. So you end up looking at the net position. Are they net after all the long shorts put together? Overall, are they really bullish or bearish in their positioning? So that gives you very interesting data points. I'll start with FIs that are the most controversial when it comes to this particular information. We clear up the data, and what we'll actually see is that whenever, and we've put red lines here again based on past experience, that whenever FIs have a very extreme long position, which in this case is more than 1 lakh contracts, it ends up marking a particular top in the market, like here, and now from this point onwards. So whenever FIs are extreme long, you can get a market top. Very similarly, if FIs have an extreme short position in the market, you can end up getting a market bottom as well. Now, this was the highest short here, which occurred in March of 2023, this particular year. So that is of particular significance because, like I said, it is the highest. Earlier, the record was actually held by COVID lows down here. That record got broken at this bottom in March 2023, and then after that we've actually seen another low high reading closer to the recent October 2023 bottom, from where markets have again rallied. So all of these points where FIs are extremely long or extremely short. Now, are we there today? We are not yet there. We are somewhere in between, and that can mean that the overall move down is not complete. So those are the type of conclusions we make, because the positioning is gyrating from extreme long to extreme short, and this can be actually, there's enough look back to see this working historically. The data became available from the NSE all the way from 2012, and we've seen extreme readings many times in the past where you can actually spot tops and bottoms. So you can actually go back, and we've put the entire data from 2012 so that you can actually get an idea of what the ranges were and how they worked before. So we are not really throwing darts in the air. And something very similar we can actually do even with client positioning. Client positioning, more often than not, is exactly opposite to the FIA positioning. So when the FIAs are short, the clients are long. Like I told you, client positioning includes everyone, not just retail clients, but HNIs, corporates, and so on. So indirectly, I would say it possibly includes your operators and strong hands in the market who are participating. And therefore, when the strong hands have a bullish posture, and not a normal bullish posture, an extreme bullish posture, that is when markets sort of tend to bottom. So we have extreme long on the client side, extreme short on the FIA side. We have seen markets tend to bottom over there. So this data is very, very useful. It's updated every day at the end of the day, and gives you insights into the medium term trend of the market. Now, another thing we do is, there are rare occasions where FIs and clients end up both being long. So we do plot a combined positioning on top, which is client plus FI net index futures. This can sometimes reach an extreme at the top or bottom, and can tell you something about what the market is actually doing on that particular time horizon. So here, for example, at this top, you will find that both client and FI data reached an extreme long. This is in December of, just before the top of December of 2022. This reached the top red line. So this does tend to happen. Standalone, when we look at the positioning data, we may not see it, but we did find such occasions. But we did find such occasions in the past, and that is why we ended up, plotting it. Here is another one close to the October highs where you had reached 2x extreme. There is a slight negative divergence which you may be able to spot between these two tops, but that eventually resulted in a final high for the market. Now, if we step to the DII data, it now takes us to slightly longer term. Okay, and why I say slightly longer term is, you'll understand from the DII behavior. they don't tend to go to extremes as fast as the FII inclined. Okay, so those guys are extremely quick in going from the long short side to the short side. Domestic institutions are not that aggressive, but they do take a posture, and they have increased their positioning in the market post 2018. So, which is why data after 2018 has become very, very interesting, and we've put red lines here again to be able to tell you where those extremes really are, so that we can actually get an idea into where the tops and bottoms were. So you see this extreme positioning here, again here, and for a third time here. Each of them, domestic institutions were extremely long close to this bottom. Even here, before the tax breaks were announced by Nirmala Sitharaman, they were extremely long in the index futures, and even at the COVID lows, they had a long position. So it's very interesting. And then if people think about this October top, we do see an extreme short position. So the way to really use this data is to wait and watch, see how it's behaved in the past and where you are. Does it get to one extreme or to the other extreme? For example, here there is a slight short positioning, almost touch the lower red line close to this point. We will see how this really works out. So slightly more longer term is also something known as the volume based put call ratio. The volume based put call ratio measures the volume of puts and calls traded and not the open interest of puts and calls at the end of the day. That's the difference between what we saw earlier in the OIPCR, which is slightly more medium term, whereas the volume put call ratio is slightly more long term, because it doesn't give you extreme readings till a long period of time, till an entire cycle is done on the monthly charts. And therefore you will only find it at the top red line when you have a major bottom. Okay, and you will find it at the bottom line only when you are starting a distribution or you are at a major top. So say this is a bottom reading which sort of happened over here in the topping process, and you actually ended up getting a negative divergence into the highs. So again here you have an extreme reading close to the red line, very close to this top, right? So what did we get here when we turned very, very positive in March 23? We started saying markets will go up, and the reason is extreme puts being traded. So that was the reasoning, and that sort of also repeatedly happened here at the bottom that we got here in October, which then said that okay, you can get another rally, one final move up. So this is the kind of reading. This is slightly more long term. Like I said, you get extreme readings only once in like a year, sometimes 2 years, depending on the cycle, and therefore this is not exactly something you can watch out for in the short term, but it can be very, very useful if you're an investor and you're looking at the right entry points in a 1 year, 2 year time horizon. Then you'd want to know when sentiment has reached that kind of an extreme, and that's where volume put call ratio is useful. Nobody talks about the volume put call ratio on most platforms. I've heard people only talk about OIPCR gyrating from 1 to 1.2 to 0.8, but the volume PCR is actually very, very effective in taking big market calls. So I think these are some of the most important indicators here. One more that I'll highlight to you that you may find useful is the futures open interest, and that's the total futures open interest including stock futures divided by an index. Okay, so I've taken a broad-based index over here, and the reason to do something like this is really that you want to see the behavior of this indicator historically, because at major tops what we found is that it ends up reaching the previous high, like this top. Okay, so now I actually don't need this arrow indicator. So what I'm going to really do over here is go back and change this, and I'm going to use a horizontal line just to mark this high point, something we have not done yet on this particular tool. We can do it in the back end, but if you actually look at it, so this is where the data peaked the last time at the top of 2018. That is exactly where the mid caps topped out, even though the Nifty appeared to hold on for the next year or two, and that is where we have reached at this point of time. There is a historical precedence, because if I go all the way back to 2008, it had reached this line at the 2008 highs. If it actually shows up that data here you are. So it had touched this line in 2008. Okay, and so that was the last peak of extreme positioning on the long side, because when we divide it by index, the reason is that if the index goes up, by dividing it and making it a ratio, what we are doing is we are saying we want to remove the amount the futures positioning has gone up by simply because of price advance. You want to know whether people bought more when it is going up, and that is what the ratio ensures. Because save the futures, if the market is just going up and the value of futures open interest going up because the market went up, right? Price went up. That doesn't mean people bought more shares. It simply means that price went up. By dividing it by price, you're removing the price effect, and you're actually looking at whether if it's rising, it means people are buying an increasing amount of shares as it goes up. And when was the last time they bought such an amount of shares? And the last time is 2008. The next occasion is 2018, and the next one is here in 2024. So interesting piece of information when you look at it this way. So we've included that as well, so that you can get an idea. Okay, so these are the key tools I think which you'll find useful. Different time horizons, like I mentioned. This one again, futures open interest by index, useful for very, very long term. Okay, not for the short term or medium term. So for different time horizons, different tools. I'll go over to diffusion indicators. Again, they are different tools for different time horizons, and I will go over them, how they can actually be useful for you to find what is really happening in the market. Okay, the first one out here is looking at how many stocks are above a certain moving average. There's a 20, there's a 50, there's a 100 and a 200. Now, based on what time horizon you can actually switch. So if you use a 20 DMA, you're surely looking at slightly medium term. So which means that if you start seeing divergences like this where stocks are not going up along with the index, it's sort of a sign that there's a topping process going on. And if you've reached the bottom extreme, near the lower red line, which is less than 10% of stocks are above the 20-day average, then possibly you're closer to a bottom. So this kind of extremes are seen. Now, once again, I'll repeat what I said in the beginning. When markets fall, you often get a spike bottom because markets fall on fear and it's very sharp. So they tend to, you get an oversold reading and it bottoms out. But topping processes are slightly slower, which is why many times you might end up getting a divergence, before a final top. So this high reading did lead to a top, but again, you got another new high, then you got a divergence, and then you finally got your correction in the market. And then you got an oversold reading at the bottom, right, at the first red line. So this is what will end up happening. At this point, we saw that you got an extreme reading and you got a bottom as well. Now, if you want to go to a higher time frame, you want to know what's happening, big picture, you'll go all the way from 20 to 200. You can choose 50 or 100 depending on what time frame interests you. And if I'm using 200, I might even want to use a Nifty 500. So you can choose which index you want to run it on. If you use the Nifty 500 and the 200 SMA, you're doing a very broad market analysis. You're trying to judge whether the overall market is at a top or a bottom. So now suddenly this becomes a long-term indicator versus a short-term indicator. So when I'm looking at this, I'm looking at when all stocks have fallen below, all stocks meaning all of Nifty 500 stocks have fallen below the 200-day average. Down here the reading is 6%. That simply means 94% of the stocks at the lows of COVID were below the 200 DMA, and that ended up being the bottom. So readings at these extreme red lines here at 15,200 in the Nifty, you were at the lower red line. All stocks had fallen below the 20 DMA. The reading was almost in, not single digits, but almost 17% was a very low reading, and that ended up being the bottom. So you pay attention to these extremes as an investor. Similarly, when you reach the top end, you do pay, attention to that as well. Now, what's important here though is that while you can have an extreme reading, it can dip a bit, it can go up again. You want it really to fall below a certain range. So there are two lines here. It's only when the data falls below 80% or 77% that the market rolls over into a decline phase. So you find that here, even though it was holding the 80% range, the market continued higher. But the real breakdown actually occurred when you broke this, right? So when this point happened, which is here, that became sort of a sign that yes, we have fallen far enough and the indicator is reversing and you have more declines to come. So that is one way of looking at it. So here also we've seen a correction. Data came back to around 74, 75. We can put another line here. So if we actually break 74, 75, it could be a sign that you have a slightly more longer term reversal. Otherwise, it can gyrate all the way down, then back up, and then back down, and then back up, as we have seen before. But at bottoms, we often get spike lows. Of course, there could always be a bottom where there's a rotational bottoming process, but spike lows are common. So say for example, down here, there was a sharp correction. the reading fell all the way down to 19, and this is before this is almost 9 months before the general elections of 2019. So this is October 2018, and then you started to see a recovery from there. One rally, second rally, third rally, and it went on, sold off here. But basically, this was an extreme low, which was not then broken for several months, even though eventually it led to a reversal to the downside post-COVID. Another extreme reading here. This one is the rally that occurred from 2016 after NPAs had been announced around banking. If you remember that event, this is when NPAs were announced and banking stocks fell very, very sharply, especially PSU banks. And then you reach this extreme low reading of almost 16%, and then from there you got a rally. Of course, this first correction was the one which involved demonetization. Another extreme low point is here, where the rupee had fallen to 69, and that was the devaluation, and then Raghuram Rajan was brought in as the RBI governor. This is the low point at the over there, with a reading of 16% of stocks only above the 200-day average, and that ended up being a very meaningful bottom. This is also when the first election rally happened. So this also was around 9 months before this bottom occurred, 9 months before the 2014 elections, and this is where the election actually happened, and the market had started to advance well ahead of that because of this extreme reading. So I find these some of these indicators, which few people look at, very, very useful. It's not just for traders; it's also for investors. And extreme points, even long term, can be interesting for traders. So that is why everybody will end up looking at something like this. Both traders and investors will be interested in knowing that you are at an extreme point where something can change. Now you can diffuse across different types of indicators. You can look at an RSI, number of stocks above above the 50-day average, 50 mark for the Nifty 500 or the Nifty 50 basket. Again, this, as you can see, this is slightly more medium term. It may not be long term. You may get an extreme low point here, and then again it reaches an extreme at the top. Very different. We've included tools because different people like to look at different things. I have taken you through what I think are the most important readings. There are, for example, readings down here which say net new 1 month highs. Okay, so you can even look at this. This is another form of breadth, that how many stocks are making new highs on an average. And if you plot it in terms of an indicator, you will see that number of stocks making new highs starts to reduce well ahead of the market top. And so it can sometimes give you an idea that, okay, if this indicator is starting to roll over, are we really seeing a market high at that point of time? You can set it for either the Nifty 500 or the Nifty 50, and it goes both ways. Okay, so different types. You can look at monthly highs, you can look at quarterly highs, or you can look at yearly highs, depending on what time frame you really want to study. Okay, so to each his own. It has been offered here, and sometimes you can even use this as a slightly more near term, because say when you get this peak and it starts falling, it means that probably prices will not advance for a while. You get a short term consolidation in the market, and then when it starts rising here, that shows increasing strength in the broad market. Now another interesting indicator you might find in the slightly more medium term is looking at how many RMI buy signals are occurring. Okay, how many buy and how many sell. This can also give you oversold, overbought readings. Can be useful to find those extreme points at times, especially. So you may say, why do we need so many indicators? And the answer is yes. Often sentiment, the most important ones which I've shown you in the beginning, through the sentiment indicators, and in diffusion I actually find the ones around the 200-day average and 20-day average most useful. The others do help in as additional confirmation. So if you get an extreme reading in not one but 3 to 4 data points, then definitely it is a much stronger reading. Say for example, at this bottom we not only saw FIs turning short, clients turning long, you also have the RMI percentage going into single digits down here at 6%, the average swing also going to single digits, daily swing going to single digits. When you have that kind of a combination, if so many indicators are telling you that this is an important bottom, then you pay attention to it. So that is the reason to have different data points. They may not all align together always, but if they all do, then nothing like it. So that's all in this discussion. I hope it gave you great insight into how to use the sentiment and diffusion indicators to know where you're in the overall market, short term, medium term, or long term, and that will accordingly help you in planning your portfolio. Thank you.